Welcome to our today's class. That is the advanced financial reporting and analysis. I want to now finalize on the last part, not the last, but the second part of our group, which is now on what we call the discontinued operations. And talk about what we call the discontinued operations, or what we call the disposal of interest in a subsidiary. Call them the discontinued operations or the disposal of interest in her subsidiary. Can talk about that. The discontinued operations, or what we call the disposal of interest in her subsidiary. Discontinued operation or disposal of interest in her subsidiary. Can just talk about that. This is generally on the second part of group. We're supposed to know the disposal of interest in subsidiaries. Disposal of interest in subsidiaries. So this is a group accounts or the business combinations. We're still on the group accounts. On the advanced financial reporting and analysis. Now we want to talk about what we call the discontinued operations. Discontinued operations, or we may talk of it as the disposal of interest. Disposal of interest. This is in a subsidiary. Disposal of interest in a subsidiary or subsidiaries. So disposal of interest in maybe subsidiaries or what we call the discontinued operations in subsidiaries, not subsidiary, maybe many on subsidiaries. Now, when we talk of disposal of interest in subsidiary, we say that subsidiary, if the company controls more than 50%, that is a parent, if it controls more than 50%, it will be a subsidiary. Now, in this case is where, let's say, A had acquired B. He had acquired 80% of B. So A may decide to dispose either the 20% of it, meaning that if he disposes 20% of his shareholding in that, or if of his equity capital, he will be having still control of 60%. So he is disposing and still maintaining it as a subsidiary, or he may dispose 30%. If he disposes 30% here, it will be now 50 what? And we know 50% that is an investment in associates. So in our case, you want to know in such situations, especially where he had acquired 80% and probably has disposed either 20 or 30%, how are we supposed to consolidate in such a situation? Now, we normally consolidate, as I said, when it is a subsidiary. So meaning that even if he disposes 20 and retains the 60%, it will be a subsidiary. So we'll consolidate for the whole of that subsidiary. But in the case where he disposes the 30% and retain, or he remains at 50%, in this case is going to be what we call a what? An associate. And therefore, for this one, we'll consolidate up to the time that it existed as a what? Subsidiary. Because we have to consolidate that when it is a subsidiary. So meaning that in this case, we'll consolidate that. And this will only occur on the income statement. For the statement of financial position, remember, as at the year end, it will not be existing as a subsidiary. And therefore, we'll have to account for that investment using the equity method. So write and say, a holding company may, during its accounting period, a holding company may, during its accounting period, a holding company may, during its accounting period, may during its accounting period, may during its accounting period, dispose of wholly or partially, dispose of wholly or partially its interest on subsidiary, its interest on a subsidiary, its interest on a subsidiary, say it may either dispose of its entire shareholding in a subsidiary, dispose of its entire shareholding in a subsidiary, dispose of its entire shareholding in a subsidiary, its entire shareholding in the subsidiary, you say, on that you say, this qualifies to be a discontinued operation. 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 A discontinued operation. Discontinued operations. And you say, discontinued operations are not consolidated. 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 Are not consolidated. Are not consolidated. Say only parent share of the discontinued operating profits. Only parent share of the discontinued operating profits. Share of the discontinued operating profits. And the profit or loss on disposal. 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 Profit or loss on disposal is included in the consolidated income statement. Is included in the consolidated income statement. Is included in consolidated income statement. Consolidated income statement. Number 2 is disposal partially its interest in a subsidiary. Dispose of partially its interest in a subsidiary. Interest in a subsidiary. Interest in a subsidiary. But still maintains a controlling interest. But still maintains a controlling interest. But still maintains a controlling interest. Still maintains a controlling interest in that subsidiary. In that subsidiary. In that subsidiary, you see. In this case, the subsidiary is consolidated for the whole year. Is consolidated for the whole year. But the NCI percentage changes as from the date of disposal. But the NCI percentage changes from the date of disposal. Changes from the date of disposal. Date of disposal. Date of disposal. The other one you say. The one is number 3. Disposal part of its shareholding. 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 Part of its shareholding. Part of its shareholding. Leaving a residual interest after the disposal. Leaving a residual interest after the disposal. Leaving a residual interest after the disposal, which is regarded either an associate, which is regarded either an associate, which is regarded either an associate, or a joint venture, or simple investment, joint venture or simple investment, Say in this case, parent consolidates the subsidiary. The parent consolidates the subsidiary. Parent consolidates the subsidiary. Parent consolidates the subsidiary up to the date it loses control. Up to the date it loses control. Up to the date it loses control. And therefore, and thereafter, the investment in equity, is accounted for Thereafter, the investment in equity is accounted for using the equity method. It's accounted for using the equity method. It's accounted for using the equity method. Is accounted for using the equity method. So that is how we do in that case. Remember, when we talk of the equity method, we use equity method as per IAS 28 to account for the investment in associates. Now, let's talk of profit or loss on disposal. Profit or loss on disposal. Profit or loss on disposal. Loss on disposal. Profit or loss on disposal. Profit or loss on disposal. See, the profit or loss on disposal to be reported in the parent income statement. To be reported in the parent income statement. Profit or loss on disposal to be reported in the parent income statement. Be reported in the parent income statement is computed as follows. Computed as follows. Now, you normally take the disposal proceeds. Disposal proceeds. Then you less the carrying amount. Carrying amount of the disposed investment. Amount of the disposed investment. Carrying amount of the disposed investment. That is what will give us what to take to what? What to take is profit or loss on the parent income statement. Profit or loss on the parent income statement. On the parent income statement. You also say the other one. And remember, if it is a loss, it has to be a negative. So if it is a loss, that is when it is a loss. So profit or loss, profit or loss, profit or loss, profit or loss, on disposal to be reported in the consolidated income statement, be reported in the consolidated income statement, to be reported in the consolidated income statement, be reported in the consolidated income statement, is computed as follows. As follows. So this is now what we take to the consolidated income statement. We normally take the disposal proceeds. Again, you will less the net assets on disposed investment, post investments, or we can just say net assets disposed on disposal date. We less that, and also you less the unimpaired goodwill. Impaired goodwill. Unimpaired goodwill. That way. Unimpaired goodwill. So that is how we get the profit or loss on disposal. Profit or loss on disposal. profit or loss on disposal. So with that, we can have an example. With that, we just have an example. That we can have an example. Advanced financial reporting paper. So we do begin with November 2020. November 2020. We do question number 2B. November 2020. We do question 2B. Can just have it here. November 2020. We do question number 2B. November 2020. We do question 2B. Can do that one very fast. The November 2020. We do question 2B. November 2020. We do question 2B. November 2020. We do question number 2B. November 2020. We do question number 2B. November 2020. We do question 2B. So this is what the question reads of November 2020. Is how the question reads. Question of November 2020. Now we've been given that we've been given that H Limited is a parent entity of group companies with two subsidiaries, S Limited and AFRA Limited. Been given that both the subsidiaries have been owned for a number of years. Given that the following statement of profit or loss and other comprehensive income relate to the group of companies. Given the statement of profit or loss and statement of profit, the statement of profit or loss and other comprehensive income for the year ended 31st April 2022. 2020. We also have the revenue, the cost of sales, gross profit, we have the distribution cost. At the main expenses, we have the profit from operations. Finance costs, we have the profit before tax, income tax. You also have the profit after tax for the year, other comprehensive income, and we have the gain on revaluation. Total comprehensive income we've been given. Additional information is that on 1st May 2017, H Limited acquired 75% of ordinary shares of S Limited, a public limited entity. The purchase consideration was a cash of 560 million, and the fair value of the identifiable Assets of S Limited was 400 million as at that date. We've been given there the fair value of the non-controlling interest at the date of acquisition was 240 million. H Limited wishes to use the full goodwill method for all the acquisition. Ordinary share capital and the retained earnings of the S Limited as at the acquisition date were 100 million and 200 million respectively, and there were no other reserves. The excess of the fair value of the identifiable net assets at the acquisition date is due to the increase in fair value of plant, which is depreciated on a straight line basis, and at a 5-year remaining life as of the date of acquisition. Given that also the H Limited had acquired 80% of the ordinary shares of AFRA Limited on 1st May 2016, the purchase consideration was a cash of 600 million. AFRA Limited identifiable net assets at a fair value of 550 million, which was equal to their carrying amount. Non-controlling interest in AFRA Limited had a fair value of 150 million at the date of acquisition. On 1st November 2019, H Limited disposed of 30% of ordinary shares of AFRA Limited for a consideration of 375. We were given that AFRA Limited identifiable net assets was 675 and non-controlling interest of AFRA Limited had a carrying amount of 175 at the date of the disposal. We were given the remaining equity interest in AFRA Limited held by H Limited owed at a fair value of 575 million on 1st November 2019. Given that after the disposal, H Limited would exercise joint control of AFRA Limited, profits and losses of AFRA Limited are deemed to accrue evenly over the year. Given that H Limited sold inventory to both S Limited and AFRA Limited at a price of 150 and shillings 45 million respectively, in the month of October 2019, H Limited sells goods at a gross profit margin of 20% to the group companies, and third parties. Given that also at the year end, half of the inventory sold to S Limited remained unsold. But the entire inventory sold to AFRA Limited has been transferred to third parties. Given that goodwill arising on acquisition has been tested for impairment annually, and as of 30th April 2019, goodwill on acquisition of S Limited had been reduced in value by 15%. As of 30th April 2020, it lost a further 5% of its original value. No impairment had occurred in respect of goodwill on acquisition of AFRA and the interest in AFRA Limited. You are required. The gain or loss on disposal of AFRA Limited to be presented in the consolidated statement of profit or loss and other what? Comprehensive income. That is how the question So we can now begin. We begin. Now, the first thing is we understand the group structure. Now, who acquired who? H is our parent. H Limited. H Limited acquired. On additional information, number one, had acquired 75% of who? S Limited. When did he acquire that? It was on 1st May 2017. H Limited also on additional information number two, he had acquired 80% of R Limited. When did he acquire this? He had acquired this on the 1st of May 2016. That is when he had acquired that. And on additional information number three, he has disposed 30%. Yeah. When did he do that disposal? 1st of November 2019. 1st of November 2019, meaning that what remained is 50%. Now the key is here. When is our year ending? Our year is ending when? This is on April 20 what? 2020. That year, April 2020. And here he has disposed this on when? November. So the key is here. How do we consolidate that? If it's on the income statement, on the income statement here, income statement, I will consolidate. There is on the statement of profit or loss, let me call it that. On the statement of profit or loss, profit or loss, I will consolidate H Limited. So I will also consolidate with S, right? But now R, I will consider the month that it existed as a subsidiary before disposal. So it had existed for how many months? That is from 1st of May 2019 to November. Those are how many months? It had existed for 6 months. So that is how we consolidate the statement of profit or loss. I've said we only consolidate when it's a what? Is a subsidiary. So before this 30% that was disposed, it had already existed as a what? A subsidiary. We continue. What about the statement of financial position? If I was to do that, the statement of financial position. On the statement of financial position, I will only consolidate H and what? H and S. R Limited was not existing as a subsidiary as of the year end, and therefore we'll only consolidate those two. Now, that is the first key thing that you need to do. So in such a situation is, when do I consolidate that? If it's the income statement, consider up to the time that it existed as a subsidiary. Statement of financial position, unaangalianga to the year end. This is not affected by months. Kama as at the year end it existed as a subsidiary, consolidate. And that is for the whole. Now let's continue. From here, the second thing that we'll do is on what we call the goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. That is it. The goodwill on acquisition. So there are two companies that were acquired here. One was the S limited, and the second one is R what? R limited. S limited, and we have the R limited. So we need shillings. This should be in million. Shillings in million. Now, I said whenever you are given the fair value of NCI, we use what we call the full what? Full goodwill. So in our case here, we'll just take the purchase consideration, which is generally the cost of investment. Now, what was the purchase consideration for A? So, an additional information number one, you had acquired this for 560 million, right? What about for R? On additional information number two, you had acquired that for 600 million. We know we add the fair value of NCI, value of non-controlling interest. What was the fair value of non-controlling interest? So S limited was 240. And this other one was fair value on number two of NCI was 150. Then from there, I will less the net assets acquired. Now, net assets acquired. What was the fair value of the net assets here? We were given them as a whole. This one on number one, it had the fair value of identifiable net assets here, they were 400. Yeah, on the other question is the fair value of identifiable assets was 550. And therefore, we can now get the goodwill. What will be the goodwill? The goodwill here should be how much? Goodwill here will be given by 560 plus 240 minus 400, which here it is 400. 600, I add 150. How minus 550? This will be 200. We go to the impairment on additional information number 5. Goodwill arising for acquisition was tested for impairment annually. And as of that year, the April 2019, that is before the year end, we are told that the goodwill on acquisition of S Limited had been reduced in value by how much? 15. So that is what we call in the accumulated impairment. Impairment. What will be the accumulated impairment here? 15% of these 400. How much is it given you? The 15% of the 400, it will be 16. Again, we were also given that during the year now, 5%, that is as of that year, April 2020, he had lost further 20. This is now the impairment for the year. Impairment for the year. The impairment for the year, here it will be given by 5% of 400. 400. This will be 20. So, meaning that now what I should have taken to the statement of financial position will be now our net goodwill, which is of how much? What will be our net goodwill? So this will be 300 and what? 320. Now, for this one, we were told that impairment had not occurred in respect on goodwill of this what? R limited. So that will be that one. We now continue. We now answer our Roman number 1. Roman 1 is a gain or loss. Loss on disposal. This is to be included in consolidated statement of profit or loss. Be included in the consolidated statement of profit or loss. Statement of profit or loss. Of profit. This or the loss. That one. How do we determine that? I said we will get the disposal proceeds. What was our disposal proceeds? He disposed these at how much? Disposal proceeds. Proceeds. What was our disposal proceed? On additional information number 3, we were told that on 1st of November 2019, H Limited disposed of 30% of the ordinary shares on R Limited for a consideration of how much? 375 million. So from there, first, I will add the fair value of net assets. The value of net assets retained. Net assets that were retained. Retained. Now, what will be the fair value of the net assets that were retained? I want you to go to the additional information number 3. The remaining equity interest in R Limited held by R was 575, the equity investment, that one. And then from there we less the net assets disposed. Net assets disposed. Now, what was the net assets that were disposed at that time? We were told that the net assets the net assets as at that time was 675. I need that. I will add also the unimpaired goodwill. First, since you have to less it, unimpaired goodwill was of how much? Unimpaired goodwill here, it is for unlimited. It is 200. This 200. So the unimpaired goodwill. And then, since there was a value of NCI, I will less that their value of NCI as at the time of disposal. Their value of NCI at the time of disposal, there we were given, it was at a current value of 175. So all this is what I less here to know what will be our gain, whether it's a gain or loss on disposal. 175. This will be 700. So less there. Is it a gain or loss on disposal? 575. Yeah, it is a gain on disposal. Of how much? 250. So that is what we get to the other comprehensive income. We take that to the other comprehensive income. Now we continue. That is what we take to the other comprehensive income. Now I will look for whether there is anything else that will affect the income statement. Check whether there will be anything else that will affect the income statement. Yeah, we have on the revaluation, on additional information number, this was on additional information number 1, working 4 year. I need to know the depreciation of what we call in the revalued assets. The revalued asset that we've been given there, the revaluation reserve. Revaluation reserve. I want you to be keen here. The revaluation reserve. Now, this is what you've been given on that question. On the third line there, after the goodwill, we were told that the ordinary share capital and the retained earning of S Limited as at the date of acquisitions were 100 million and 200 million respectively. There were no other reserves. The excess of the fair value of the identifiable net assets is due to increase in fair value of what? Of the plant. So, now the first thing is I need to know what is the fair value of these identifiable net assets of identifiable, or I just say the fair value of the net assets. It was this 400 here. So if I less these other two, the ordinary share capital, which was over 100. If I also less, the other one was a sharehold, the retained profits of 200. What I retain here is now that revaluation, the revaluation reserve. And this revaluation reserve was in respect of what? Plant, which is how much? It will be 100. So I need to know the depreciation of this plant. The depreciation of the plant. We were told that it is being depreciated at what rate? In the remaining useful life of 5 years. So I'll just take 100 divided by 5, which is depreciation. This one will take to the cost of sales as an expense. We continue. This was working one. This should have been, anyway, I don't have to indicate that. The other one is on additional information number 4. On what we call the intergroup what? Intergroup sales. So we were told that H Limited sold inventory to S Limited and R Limited at a price of 150 and 45 respectively. Now what I will consider is just the one from H to S. Because as at the time that we are doing consolidation, is the S Limited was existing as a what? As a subsidiary. R Limited exists kama what? Subsidiary. So the intergroup sales will be of how much? 150 million. We know this one, we're supposed to less it on the revenue. You less the revenue. You also less on the cost of what? You also less on the cost of sales. This one I've said you add on the cost of is an expense. You add on the cost of sales. Continue. We were also told that H Limited sales goes at a gross profit margin of 20%. At the end of the year, half of goods sold to S Limited remained unsold. If they remain unsold means that there is what we call unrealized what? Unrealized profits. Half of them, which was of 150, right? I will multiply by the profit margin, because that was the selling price of 20%. That was at gross profit margin. So how much is it given you? How much is it given you? How much? 15. That should be 15. So where do I take this? I will add it. We normally add it on the cost of sales. We also less on the closing inventory that way. There is nothing else that I need to work out. I can now consolidate. So this will be on Roman number 2. They will require X group. This will be X group consolidated. Consolidated statement of profit or loss. Or profit or loss. This is for the year ended when statement of profit or loss and other comprehensive income and other comprehensive income for the year ended when the year ended that year April 2020. That year April 2020. That year April 2020. I will have your shillings in what? Million. Shillings in million. So we begin with the revenue. Revenue here. I will take the revenue for 42.75. I will also add 25.15. I will also add this other one is 17.30. Remember, this should be 17.30. I multiply by how many months? 6/12. The period that R Limited existed as a what? Subsidiary, and then the intergroup sales are less 150. How much is it giving you? Inakupea ngapi? 275, 25.15, 17.30, 6/12. I'll minus 150. This is 75.05. 75.05. Continue. We less the cost of sales. Cost of sales we were given. This was 27.35. I will add, this is 14.45. I will add, this is 10.10. I'll multiply by 6/12. I'll minus the intergroup sales. I will add the depreciation for the year, which was of 20. And also I add the closing, the unrealized profit on closing what? Stock. How much is it giving you? 27.35, 14.45. 10.10, you multiply by 6/12. 150, 20 plus 15. This is a 45.70. So from there you can less. Less here, what you get is what? The gross profits. So what was the gross profits? 505 minus answer. This is 29.35. 29.35. Continue. Continue. From there we have I will have the profit on disposal. Profit on disposal, which was of how much? He has disposed it at a profit of 200 and what? 250. And there is no other profit there, so I will less the expenses. Less the expenses. Expenses, we begin with the first one. It was the distribution cost. Distribution cost. Distribution cost, you just take 305 plus 195 plus this other one is 90. Multiply by 6/12. Give you how much? 305. 195 plus now 45. That is 545. Continue. Administrative expenses. Administrative expenses. Administrative expenses, there we had this is 370 plus the other one is 235 plus this other one is 120, 6/12. I will also add the impairment for the year, which was 20, that impairment of 20. How much is it giving you? 370, 235, 120 times 6/12. You add 20. How much is it giving you? 680? 685. You also have the finance cost. Finance cost here is of how much? 45. I add 40. And I add 30 times 6/12. This is 100. What was the profit before tax? $29.35, 250, 545 minus 545, 685 you minus 100. This is 1855. So you less the income tax. Tax expense. The income tax expense. So this was a 161.20. 120 plus 100. 6/12. To give you how much? 6/12. So how much is it giving you? 300 and this will be equals to how much? The profit after tax. 1855 plus 330. Minus 330 will be 15, 20, 25, right? 15, 25. I will add the share of associate. Share of associate profit. . Now, the associate is now for the next 6 months after you dispose that. So, any profit relating to that he was supposed to get his share. We know he will be controlling 50%. So it's 50% for the profit after tax, which is 380. You multiply by 6/12. Tapata ngapi? 6/12. You will get is 95. So what will be the total profit? 1525 plus the answer. You will be having a profit of 1620. We'll add other comprehensive income. Comprehensive income. Other comprehensive income here, the gain on property revaluation. Gain on property revaluation. Gain on property revaluation will be the 150 plus 80. How much? 230. So if you add, what will be the total comprehensive income? What will be the total comprehensive income? It will be 1850. And that is how you are required to do that one. That is how you are required to do the question. Any question on that? You can also try December 2021 question 1. December 2021 question 1. You can also do that. December 2021 question number 1. Can do December 2021 question number 1. Is there anyone who is having question on this? This is a question that you are expecting. You are either expecting it's just on the disposal, because in foreign subsidiaries, in a group, they either bring you a question on acquisition, which was there in the previous sitting, disposal, a foreign subsidiary. So you have two options here, either on this one that we are talking about, or foreign subsidiaries. We are getting to the foreign subsidiaries as from our next class. Now we continue. So we can also do this other one. The other one that I've indicated here, December 2021, question number 1. December 2021, we do question number 1. December 2021, we do question number 1. December 2021, we do question number 1. Now this is what the question reads. What the question reads. Pareto Limited is the holding company of a listed group of companies with its year ended 30th June 2021. Pareto has made a number of acquisitions and a disposal of an investment. Following summarized draft statement of financial position relate to group companies for the year ended 30th June 2021. Given that assets, the non-current assets, the property, plant, and equipment, investment we've been given for Pamba Limited, therefore, and we have the financial assets. We also have the current assets where we have the equity and liabilities on the equity. Have the ordinary share capital, share premium, and we have the retained earnings. Total equity we've been given there, and we also have the non-current liabilities and current liabilities. Additional information on 1st October 2020. Pareto Limited acquired 80% equity interest in Bamba Limited, where its retained earnings stood at 3,500 million. Purchase consideration comprised of total of 50 of Pareto Limited ordinary shares of at the date of acquisition of with a nominal value of 1 and a market value of 6.8 each. Given that at acquisition of Bamba, the only adjustment required to be the identifiable net assets of Bamba Limited was for land, which had a carrying value of 625 with less than its fair value. Group policies to mention and controlling interest at fair value. The date of acquisition, Bamba Limited non-controlling interest had a fair value of 21.25. Pareto Limited had acquired 100% equity interest in DAFU Limited on a number of years ago, when its net assets, when its retained earnings amounted to 1750. At the acquisition, the fair value of the identifiable net assets of DAFU Limited earnings amounted to 1750. Approximated their carrying value. Purchase consideration comprised of a cash of 5750. Pareto Limited disposed 60% of its investment in DAFU Limited on 1st of April 2021 for 4,700. Given that when the fair value of the identifiable assets of DAFU Limited was 6250, the value of the remaining 40% equity was 43 at disposal. Pareto Limited has not accounted for the disposal. None of the companies had issued any shares since Pareto Limited acquired its shareholding, and neither goodwill on acquisition of subsidiary nor the investment in associate had been impaired. You are required the goodwill on acquisition of the investment in the what? Subsidiaries. So here is Pareto. So I just need to know, huyu ni Pareto. Nimwite P, wote ni Pareto. Kuna Pareto aliacquire, this is 80%. This was on 1st of October 2020. And then he also acquired, this is DAFU. DAFU had acquired 100%. So he had fully owned that, and he had acquired it some years ago. So you have to hitaji kujua. We only want to know when he disposed the 60%. He disposed the 60%, meaning that he ilibaki 40%. When? He disposed that on 1st of April 2021. April 2021. So how do we consolidate that? Consolidation on the statement of P and L. Kama tungekuwa tunaiconsolidate hapa, tungechukua nani? Pareto. Sawa. You add also the Darfur. I mean, Pareto aliacquire huyu nimeita Pamba. So to add Pamba exists as a subsidiary for how many months? If he was acquired on October and our year ends on 30th June, he had existed for 9 months. So huyu tunge consolidate for only 9 what? Months. Ni sawa. And then for huyu Darfur aliuzwa lini? Aliuzwa on the 1st of April 2021, meaning that he had existed as a subsidiary for how many months during that year before akuwe disposed of. Remember, our year ends on 30th June. So he had also existed for 9 months. Sawa. Hiyo ingekuwa hivyo. It was disposed on 1st of April and our year ends on so ingekuwa April, May and June. Ndio alikuwa ameexist kama associate. Now what about the statement of financial position? Now the one that we are required to prepare of a financial position. Here we'll only consolidate Pareto and who? Amba. Sawa. As at the year end, this Darfur was not existing as as a subsidiary. So we continue. We begin with number 1, the goodwill on what? On acquisition. Goodwill on acquisition. So goodwill on acquisition we have for what? We have for he acquired Pamba Limited. And he also had acquired Darfur Limited. So shillings here I'll use in millions. Shillings here they will be in millions. So we begin with the purchase consideration. Purchase consideration for Pamba Limited was of how much? He acquired it at 3,500. Ni 35 take total of 50 you multiply by 6.8 ama uangalie kwa investment tumepewa ite 500. On non-current assets angalia hiyo pia hii ilikuwa 57. Yeah, you can take the total of 50 you multiply by 6.8 or you can use what we've been given on non-current assets. There was a fair value of NCI. Value of NCI. What was the fair value of NCI for Pamba Limited? On additional information number 2, it was 2125. This other one was of how much? Their value for this one was tuna. Sindio? Kumaanisha now here I will use the full goodwill. Here I'm using the partial goodwill. So we less the net asset acquired. Net assets acquired. Net assets acquired, here I have the ordinary shares. Ordinary shares here were of how much? 2,500. Hapa zilikuwa ngapi? 2,000. We also have the share premium of how much? Share premium here. We were given there, these were 1,000. And this other one was of how much? The other one is 500. I also need the pre-acquisition retained profits. The retained profits. As at the moment it was acquired, the retained profits here they stood at 3,500. Here they stood at how much? Retained profits here, they stood at how much? 17 what? 17.15. There was only one fair value adjustment on number one for the revaluation of land. Valuation reserve. Yangapi? It was 625. 625. So get the summation here. Here it will give you how much? So 2,500, 1,000, 3,500 plus 625. Yeah, I will add the 76.25. So what will be our goodwill? So goodwill here will be 8,500 plus 21.25 minus answer. This will be 3,000. Here there was no impairment of goodwill. So here it will be 22,000. I will add 500 plus 17.50. So this is 42.50. Here we only consider the parent shareholding. He had acquired 100%. So here it back to the 42.50. What will be our goodwill? What will be our goodwill? Goodwill here will be 15 what? 1,500. That is Roman number 1. So on Roman number 1, we have the 4 marks by just doing that. Go to Roman number 2. Want the gain or profit or loss on disposal of investment. Gain or loss on disposal. This is now to be included on the Pareto Limited. That is the individual to be included. This is to the Pareto income statement. Pareto income statement. So what we'll be able to include on the Pareto income statement will be, you will get the disposal proceeds. The disposal proceeds. What was our disposal proceeds? On additional information number 4, he disposed it for 4,700. So we less, I said we less the carrying amount of the disposed investment. So the carrying amount of the disposed investment, it disposed 60%. So you just take 60% of the purchase consideration, 57.50. How much is it giving you? 0.6, 57.50. This will be 34.50. Here itakuwa ya ngapi? To be 4,700 minus 34.50. Hiyo inakuwa ya 12.50. That will be the gain on disposal. Hiyo ndo tunapeleka kwa parent what? Income statement. What about what you now to get to take to the consolidated? Or do we take to the consolidated income statement? So here it will be gain or loss or loss to be included. This is in the consolidated income statement. Consolidated income statement. So here we'll again take the disposal proceeds. The disposal proceeds, they were 4,700. We'll add the fair value of net assets retained value of net assets retained. Ngapi zilibakishwa? We were told on additional information number 4 that the fair value of the remaining 40% was how much? 4,300. So we less the net assets disposed. Net assets disposed here, they were of 6,250. 6,250. Net assets disposed was 6,250. And then also we'll have the unimpaired goodwill. Unimpaired goodwill ni ngapi? What was the unimpaired goodwill? The unimpaired goodwill is what we've been able to compute here of 15. Here we were not given the fair value of NCI as at the date of our disposal. So I'll just less that. So 6,250, 1,500. This is 7,750. If you less that, 4,700 plus 4,300 minus answer. This is 1,250. So that is the gain on disposal. That will be the gain on what? The disposal. Is that okay? The gain on disposal. So from there we can now get the other values. I will look for the investment in associate. Investment in associate. Investment in associate. So what will be my investment in associate? It will be the cost of the investment, which is now what was retained. They retained it at 4,300. I will only add the post-acquisition retained profits. Post-acquisition retained profits. Now, what will be the post-acquisition retained profits? It will be 40% as at the year end. What is the net assets? I mean, what is the retained earnings of this? It is 57. Not only 57.50. The retained earning, right? As at the time of disposal, kwa ngapi? On additional information number 4, Pareto Limited, the value of the remaining net assets were 43. As at the year end, the retained earnings is how much? Or like just, because this one we add the post-acquisition changes in net assets. Acquisition changes, just say that. The acquisition changes in net assets. So this will be just a 40%. I need to know the total net assets here. They were 8,250 as at the year end. As at the time of disposal was 62.50. So itakupea ngapi? Ndo hii. So it will be 8,250 minus 6,250. and I multiply by 0.4. So this will be 800, meaning that this will be what? 5,100. We'll also need to do for the retained earnings. Retained earnings, a minute. So we can now finalize. So we go to the retained earnings. Go to the retained earnings. The retained earnings. So we'll begin with the parent retained earnings. What was the retained earnings for the parent? Retained earnings for the parent, they were how much? 78, 25. We also had the profit on disposal. What we take to the consolidated here, we know this will go to the parent, senior user. Sawa sawa. Then I will add the share of profits from now there was the investment that he from these other companies that he had acquired. So from Pareto, is it Pareto or Pamba? We begin with Pamba. Pamba he had acquired what percentage? 80%. So it will be 80% of the profits. What is the retained profits as at the year end? They were 5250. As at the time of acquisition, what was the retained earnings? It was 3500. Yeah, itakupea ngapi? How much is it giving you? How much? How much? So be 0.8 times 5250 minus 3500. This will be 1400, right? Then we add for Dafu. Now, hapa atapata mara mbili. The first time is at the time he had acquired the 100% the subsidiary. So here it will be the 100% of what was at the time of disposal, what was the value of the net assets? As at the time of disposal, the net assets here, they were 6250. I will just less there as at the acquisition, 4250. You need to pay the first profits. So, which in this case will be 6250 minus 4250. Then 100%, this will be 2000. Now, I will also need for the time it was an associate. This is now on 40%. This is now as at the year end. What was the total for the net assets? It was 8250. I will less now 6250. How much? 8250 minus 6250. I'll multiply by now 40 what? Percent. This will be 800. So get the retained earnings. So when 825 plus 1250, 1400 plus 2800. This will be 13,275. We also need to know for the NCI. The NCI. Now for the NCI, we were given there the fair value of NCI. What was retained? What was the, we were given the fair value of the NCI because hii ingine aliuza. So we only want for the, this is now for this other company that is remaining as a subsidiary, Pamba. What was the fair value of Pamba? The value of Pamba Limited was 2125. So I will add the post-acquisition profits. Post-acquisition profits. Yani tunasema this now the 20% yenye ilienda kwao. 20% of how much? This the 5250 minus 3500. Kupea ngapi? You multiply 5250, 3500. This is 300 and what? 50. So add that. Niambie nakupea ngapi? 2125. This is 2475. So we can now consolidate. We consolidate now. Consolidate. So we have this is Pareto group. Pareto group. They wanted us to do the group statement of consolidated statement of financial position. consolidated dated statement of financial position. Financial position. This is as at when? That is April 2020. That is April 20. I mean, that is June 2021. 2021. Shillings are in what? Million. So we'll begin with the non-current assets. Non-current assets. So for the non-current assets here, we have the PPE. What was the PPE? I've said we'll only consolidate the what? We are only consolidating Pareto and the Pamba, 9250. I will add the 65. I mean the 625. 625 is this revaluation. You need to adjust for that revaluation, which in this case, it will give you how much? You need to adjust for that revaluation. It will be 14,900, 9250, 625. This is 24,775. We also have for the in goodwill. Goodwill here was of how much? To be of 3,000. The goodwill will be that of 3,000. You also had the investment in associates. Investment in associates. Investment in associates we've computed here to be of 5,100. Then also I see we have the financial assets. What was the financial assets? Financial assets here we have 3,100 plus 2,800. Inakupea ngapi? 3,100 plus 2,800. This will be 5,900. We also have the current assets. Current assets. Current assets here we have 3,850. This is plus 4,425. And then waliuza, kumaanisha the disposal proceeds, they are receiving this 4,700. Takupea ngapi? 850 plus 4,425, 4,700. This will be 12,970. So get the total assets. Total assets. Total assets will be 24,775, 3,000, 5,100, 5,900 plus answer. This is 51,750. 51,750. Go to equity and liabilities. Equity and liabilities. Equity and liabilities. On equity and liabilities, here we have the ordinary share capital. Ordinary shares. Here we know we pick only for the parent, 10,000. We also have the share premium. Share premium, we also know we pick for the parent, 5,000. I've also computed the retained earnings. What was the retained earnings here? The retained earnings is 13,275. 13,275. And then I also have the non-controlling interest of 24,75. Continue, we go to equity and liabilities. The non-current liabilities. Non-current liabilities. Non-current liability will be 8,500 plus 6,000. Here there was nothing that was affected by that. So it will be 14,500. Current liabilities. current liabilities. Current liabilities here will be 47.75. I will add, this is at 17.25. I'll add 17.25. There is nothing else. So is that. So this will be 47.75, 17.25. This will be 16. So get the total equity and liabilities. Total equity and liabilities. Total equity and liabilities, 10,000, 5,000, 13 to 50, mean 275, 2475, 14,500, 6,500 is 51,750. And that is how you are required to do the question. That is how you are required to do that given question. So at your own time, try the following as assignment. April 2025, do question 2. April 2025, do question 2. December 2024, do question 2. December 2024, do question 2. August 2024, do question 2. August 2024, do question 2. April 2024, do question 2. All that, meaning that even in your sitting, it will be there question 2. So we continue from there. We'll come and do now the foreign what? Foreign subsidiaries. Any question? Any question? No question, then we continue from there in our next class.